Are you trying to raise capital for your next real estate development deal? Here is something most beginners don't realize. The key to funding your entire project might not be the bank. It might be a person. I'm Josephine, owner of Sapphire Development Group, a vertically integrated real estate development firm in Nashville, Tennessee. I built an 8-figure development pipeline in just a couple of years, and now I teach other real estate professionals on how to do the same. If you're trying to raise capital for your next venture, understanding accredited investors is so crucial. These are the people who could write the check that makes your entire project happen and could change your life trajectory. But who exactly are they? How do you find them, and why do developers love working with them? Let's break it down in today's video, and let's start with the basics. What is an accredited investor? An accredited investor is someone who meets specific financial criteria set by the SEC, so a Security Exchange Commission, that qualifies them to invest in higher risk private deals like your real estate project. I always like to say essentially any kind of private deal is sort of quote unquote is what makes the rich richer. That's the furthest away really from the public markets that are highly governed by the SEC. So in today's video, I'm going to show you of how to do direct investments and also how to protect yourself when you're raising capital. Now, keep in mind, I'm not an attorney. This is not legal advice. It's just based on my own experience. You always want to talk to an attorney. To qualify, someone must have one of these 3 next components. A, $1 million of net worth, not including their primary residence, or if you're single, $200,000 annual income year over year, or if you're married, $200,000 in the last 2 years. Now, there's one other qualifier that if you're a professional and hold a financial license, then you can also qualify that way. Otherwise, if you're an owner of the LLC or you're, doing projects really as an operator, then that's how you really get started, especially with sweat equity when you don't have the capital in the very beginning, like when I started about 7.5 years ago. Now, if the investor meets any of those criteria I just listed, they're considered accredited, okay? That opens the door to private offerings, syndications, and development deals. Now, yes, these are often high net worth individuals, but we're not just talking about CEOs, Wall Street types. These could be surgeons, successful business owners, retirees with strong portfolios, or high earning tech employees, right? Anybody that makes a lot of money. Now, so why do developers want to work with accredited investors? Well, because it makes raising capital faster and easier. If you're raising capital directly for development and want to stay compliant while maximizing flexibility, there are a few key SEC exemptions you need to understand. But before I break those down, let me tell you how I like to structure my capital raises. Personally, I think it's always best to keep things simple. For most projects under $5 million, I look to bring in a few large check writers and fund the deal through a joint venture structure rather than doing a full syndication. Now, another way to do this is also to go a lending route, which we can do a whole nother video on. And if you don't know what a syndication is, it's when a group of investors pool their money to fund a real estate deal, and one person or a team called the sponsor runs the project. The investors are truly passive. They fund it, and the sponsor handles everything from acquisition to exit. So why do I avoid syndication when possible? Because the fewer investors you have, the less investor management you have to do. And that's one of the biggest benefits of direct investments on residential or urban infill projects. Now, if you're working on a larger project, let's just say over $5 million in costs, especially multifamily, you'll likely need to syndicate and get clear on SEC regulations. And again, none of this is legal advice. You must talk to a securities attorney before raising capital just to cover your basis. But here's a quick breakdown on the 2 most important regulations you need to know. First, you got Reg D 506B, also called the friends and family route. You can't publicly advertise the deal. You can raise unlimited capital, but you can only accept up to 35 non-accredited investors if they're sophisticated. And you need strong disclosure docs if you include non-accredited investors. I really don't recommend that. It's great if you already have a warm network, but you can't post the deal on social media or run ads. Next, you've got Reg D 506C, which I call advertise it, but verify it. You can publicly advertise your offering, but only accredited investors can invest. And you must verify their accreditation via, for example, the tax records like W-2s or CPA letter. They basically have really got to confirm that they are in fact accredited. There are no caps on how much you can raise. And it's perfect if you want to grow your investor base publicly, but you'll have more paperwork and verification steps. The big picture here is this. With accredited investors, you can use Reg D 506C and market your deals publicly. You can skip a lot of legal red tape, and they usually understand the risk, and they can write bigger checks, which means fewer investors in your deal. And it's not just about the money. It's about working with people who are ready to invest and not just curious or hesitant. So where do you find these accredited investors? You don't go knocking on doors. You go where they already are or likely going to be. Invest yourself in nonprofits, network at galas or any kind of charity events. You can also check out country clubs or golf, tennis, or even baseball class. Angel investor groups, even crypto groups, right? Real estate investment meetups, high-end financial advisors might be great. And don't forget about your own network. You might be surprised, but you can always check out doctors, lawyers, successful entrepreneurs, and they might already qualify and not even know it. But just ask them if they already invest in real estate and ask them what they're already doing to learn more about where they're at and where they're trying to go. Now, when you meet them, here's what matters: a strong track record or a team with one. If you don't have a track record yourself yet, don't be discouraged. There's a way to get started. Again, when I started, I didn't have the track record either. So just comment down below or get in touch with us. A clear, clean deal structure, a professional, well thought out pitch, and also performance to back it up. And the ability to speak clearly and confidently when you talk numbers. Have your passion show through. It really matters that you're really passionate about the deal. People are going to invest because of you. So you've got to show up at your best. So most of these deals are structured with a general partner and a limited partner setup. The GP, that is you, runs the project, and the LPs, the investors, provide the capital. Profits are split based on your agreement, okay? And so we have another video covering that. So can you raise money from any non-accredited investors? Yes, you can, but it is trickier. There are rules and you may need a different exemption. You'll have limits on how many non-accredited investors you can include. And most of the time, you can't publicly advertise. And that's why many developers start with friends and family in a joint venture type structure and a direct investment to keep it simple. But scale with accredited investors. Now let's talk about mistakes to avoid. Here are 3 major pitfalls I see people make all the time. For one, they're promising guaranteed returns. Don't do that. 2, raising money without proper legal documents. And I'll tell you from my own experience, it takes years to really get your documents to where you want them to be. And 3, violating SEC rules. Because yes, the fines and bans are real. You don't want to deal with that, so always make sure your deals are clean. And you do not want to end up in a securities investigation because you didn't know the rules. Saying that you didn't know is not going to help you. If you want help avoiding those mistakes and learn for best practices, this is the kind of stuff we walk through in our Developer Academy. So let's wrap this up. Understanding who accredited investors are and how to find and work with them might be the difference between stalling out and getting your next deal funded. To recap, accredited investors have the cash, the risk tolerance, and the legal clearance to invest in your project. They can also help you raise capital, and if you pitch them the right way, you're well on your way to get funded. If you don't want to do this on your own and want coaching on how to raise capital effectively and work with accredited investors, check out Developer Academy. I'll link it below. This is our coaching program where we walk through funding strategies, legal structures, investor conversations, and also get you live support to help you work through real deals. If you got value from today's video, please like, subscribe, and drop a comment sharing what you've learned. I would love to hear what your takeaway was. And if there's anything you want me to cover next, be sure to let me know. This is going to help us tailor the content really to your needs. And I post videos every week, and I'm here to help you grow your development business and raise capital with confidence. See you in the next one.